Expected credit losses can look scary because the question mixes accounting rules, risk language, and calculations. But every ECL question is really asking the same thing. What asset are we dealing with? What stage is it in? How much loss allowance is needed? And what happens to profit or loss? In this video, we build the full exam method from zero, then apply it to loans, discounting, trade receivables, journals, and written explanations. Here is the map before we start. First, decide which impairment approach applies. Is it the general three-stage model or the simplified approach for trade receivables and some contract assets? Second, classify the asset into stage 1, stage 2, or stage 3. Third, calculate the expected credit loss. Fourth, work out interest income because stage 3 changes the interest base. Fifth, write the journal entry and explain the moment clearly. If you can follow those 5 steps, you can answer almost any SBR ECL requirement. Under the old standard, IAS 39, entities only recognized a credit loss when there was objective evidence that a loss had already occurred. That was called the incurred loss model. The 2008 financial crisis exposed the weakness. Losses were recognized too late. IFRS 9 changed the mindset. You do not wait for default. You estimate the credit losses you expect using current conditions and forward-looking information, and you recognize an allowance earlier. The first exam decision is scope. The general ECL model applies to financial assets measured at amortized cost, debt instruments measured at fair value through other comprehensive income, lease receivables, loan commitments, and financial guarantee contracts where IFRS 9 impairment applies. But trade receivables are usually tested using the simplified approach. That means no stage 1, stage 2, or stage 3 assessment is needed. You recognize lifetime expected credit losses from day 1, often using a provision matrix. So before you calculate anything, identify the asset and choose the model. An expected credit loss is a probability weighted estimate of credit losses, discounted to present value using the effective interest rate. The exam formula is simple. ECL equals PD multiplied by LGD multiplied by EAD, then discounted where necessary. PD is probability of default. How likely is the borrower to fail? LGD is loss given default. If default happens, what percentage will not be recovered? EAD is exposure at default. How much is owed when default happens? In real IFRS 9, ECL is probability weighted across possible outcomes. So it is not just the single worst case. Use this method every time. Step 1. Identify the asset and impairment approach. Step 2. Decide the stage using evidence since initial recognition. Step 3. Select 12-month ECL or lifetime ECL. Step 4. Calculate the allowance using PD, LGD, EAD, and discounting if the loss occurs in the future day. Step 5. Explain the profit or loss impact, interest income, journal entry, and any movement in the allowance. This method stops you from writing random rules and helps you build a complete answer. Stage 1 is the starting point for most financial assets at initial recognition. The asset is performing and there has not been a significant increase in credit risk since origination. In stage 1, the entity recognizes 12-month expected credit losses. This does not mean 1 year of interest. It means the portion of lifetime expected losses that could arise from default events possible within the next 12 months. Interest income is calculated on the gross carrying amount. Stage 2 is triggered when credit risk has increased significantly since initial recognition, but the asset is not yet credit impaired. Common indicators include a credit rating downgrade, worsening cash flows, adverse economic conditions affecting the borrower, or payments more than 30 days past due. The 30-day rule is a rebuttable presumption, so it can be overridden only with reasonable supportable evidence. In stage 2, the allowance changes from 12-month ECL to lifetime ECL. Interest income is still calculated on the gross carrying amount. Stage 3 is reached when the asset is credit impaired. This means there is objective evidence of impairment, such as default, bankruptcy, administration, major financial difficulty, or payments more than 90 days past due. Again, the 90-day rule is a rebuttable presumption, but the evidence must be strong. Stage 3 still uses lifetime ECL. The key change is interest income. It is calculated on the net carrying amount, meaning gross carrying amount minus the loss allowance. This is one of the most common SBR traps. Stages are not a one-way road. If credit risk worsens, the asset moves from stage 1 to stage 2 and possibly to stage 3. If credit risk later improves, the asset can move back. For example, if a stage 2 borrower catches up on payments and credit risk returns close to the level at origination, the asset may return to stage 1 and the allowance goes back to 12-month ECL. In written answers, let us apply the method. On the 1st of January 2026, Moonco grants Skyco a $5 million secured loan, repayable on the 31st of December 20x9. Interest is 3%, paid annually. At 20x6, there is no increase in credit risk. 12-month probability of default is 5%, and present value shortfalls are $200,000. At 20x7, credit risk has increased significantly. Lifetime probability of default is 45%, and lifetime shortfalls are $400,000. At 20x8, the loan is credit impaired. Expected recovery is $4 million, and the gross carrying amount is $5.15 million. At 20x6, the loan is stage 1 because credit risk has not increased. Stage 1 uses 12-month ECL. $200,000 multiplied by 5% gives $10,000. Interest revenue is on the gross carrying amount. 3% times $5 million, giving $150,000. At 20x7, credit risk has increased significantly, so the loan moves to stage 2. Stage 2 uses lifetime ECL. $400,000 multiplied by 45% gives $180,000. The previous allowance was $10,000, so the increase is $170,000. Interest is still based on the gross carrying amount, so it remains $150,000. At 20x8, the loan is credit impaired, so it moves to stage 3. Lifetime ECL is $5.15 million minus recovery of $4 million, giving $1.15 million. The allowance increases from $180,000 to $1.15 million, so the movement is $970,000. After credit impairment, interest uses the net carrying amount. For 20x9, 3% multiplied by $4 million gives $120,000. Lifetime PD of 6%, LGD of 60%, and an effective interest rate of 8%. First, calculate the undiscounted expected loss. 6% times 60% times 500,000 equals $18,000. If the cash shortfall is expected at the end of year 3, discount it using the effective interest rate. The discount factor is 1 divided by 1.08 cubed, which equals 0.7938. Present value ECL is 18,000 times 0.7938, which is $14,288. If the 12-month PD were only 1.2%, the stage 1 allowance would be $3,600. This is why stage 2 matters. Lifetime ECL can be much larger. Trade receivables usually use the simplified approach. There is no stage classification. Lifetime ECL is recognized from day 1. Cardwell Limited has $820,000 of trade receivables. The provision matrix says 0 to 30 days past due, 500,000 at 1%, giving 5,000. 31 to 60 days, 200,000 at 3%, giving 6,000. 61 to 90 days, 80,000 at 8%, giving 6,400. Over 90 days, 40,000 at 25%, giving $10,000. Total allowance is $27,400. The journal is debit, impairment loss, and credit loss allowance. But do not stop at history. The matrix must be adjusted for forward-looking information such as a recession, customer sector risk, or changes in collection experience. In SBR, the calculation is only half the answer. You also need clear accounting treatment. For an increase in allowance, debit impairment loss and credit loss allowance. For a decrease in allowance, reverse part of the impairment loss, depending on the facts. For debt instruments at amortized cost, the allowance reduces the carrying amount through an allowance account. For debt instruments at fair value through other comprehensive income, the asset remains at fair value, but the loss allowance is recognized in profit or loss with the corresponding entry through other comprehensive income. In your written explanation, use this structure. Identify the stage, state whether 12-month or lifetime ECL applies, explain interest income, and explain the profit or loss effect. Before the final checklist, here are the common mistakes that cost marks. Mistake 1. Treating 12-month ECL as 12 months of interest. It is not. It is expected credit losses from defaults possible in the next 12 months. Mistake 2. Moving to stage 2 but forgetting to use lifetime ECL. Mistake 3. Moving to stage 3 but still calculating interest on the gross carrying amount. Stage 3 interest is on the net amount. Mistake 4. Using historical default rates without adjusting for forward-looking information. Mistake 5. Applying the 3-stage model to normal trade receivables when the simplified approach normally applies. If you avoid these 5 mistakes, your answer already looks much more professional. Here is your final checklist. 1. Do not confuse 12-month ECL with 1 year of interest. 2. Stage 2 means lifetime ECL but interest is still on the gross carrying amount. 3. Stage 3 means lifetime ECL and interest on the net carrying amount. 4. 30 days past due suggests significant increase in credit risk. 90 days suggests default or credit impairment unless rebutted. 5. Trade receivables normally use the simplified approach and lifetime ECL from day 1. 6. Always adjust for forward-looking information. 7. Show the movement in allowance through profit or loss. If you remember that checklist, ECL becomes a method, not a memory test. That is the full end-to-end guide to expected credit losses for SBR. You now have the concept, the scope decision, the 3 stages, the calculations, the journals, and the exam wording. Follow RevPro ACCA for more SBR revision and visit RevPro Club for more resources.